Have you ever noticed something strange? You get a raise, your salary increases, and yet, a few months later, your financial life feels almost exactly the same. Maybe you earn more than you did 2 years ago, but somehow, the rent is higher, the car payment is larger, the subscriptions have multiplied, and your bank account still doesn't seem to grow. This is not always because you are irresponsible with money. Sometimes, the problem is much quieter. Your lifestyle has simply learned how to consume your income. Imagine someone earning around $5,000 a month after tax. At first, that sounds like a comfortable income for a young professional in the United States or Europe. They pay $1,700 for rent or a mortgage. Around $500 goes toward a car payment. Insurance, fuel, and maintenance add another $350. Student loans or other debt require $300. Groceries cost about $600. Utilities, internet, phone bills, and subscriptions take another $350. That is already $3,800 committed before restaurants, travel, clothing, entertainment, emergencies, or unexpected expenses. On paper, there is still $1,200 left. But this is where lifestyle inflation quietly begins. The person gets a raise. Maybe their monthly take-home income increases from $5,000 to $6,000. Most people imagine that the extra $1,000 will improve their financial position. And sometimes it does. But often, something else happens. The apartment becomes slightly nicer. The old car is replaced with a newer one. The monthly car payment increases from $500 to $750. Eating out becomes more frequent. A few more subscriptions appear. Weekend trips become normal instead of occasional. The credit card balance becomes slightly larger because the person now believes they can afford it. The income increased by $1,000, but the lifestyle increased by $900. So financially, the person is only $100 better off. This is one of the strangest features of modern personal finance. The more money you earn, the more expensive your normal life can become. And the problem is not that every upgrade is bad. A better home can genuinely improve your life. A safer car can be a reasonable decision. Better food, travel, and experiences can be valuable. The problem begins when every increase in income automatically becomes a permanent increase in spending. Because once a lifestyle becomes normal, reducing it feels like losing something. This is where psychology becomes more powerful than mathematics. When your income rises, your reference point changes. $5 coffee may have felt expensive when you were earning $3,000 a month. Later, when you earn $6,000, the same $5 coffee feels insignificant. The problem is that small decisions rarely stay isolated. $5 hair, $20 there, a more expensive phone plan, larger car payment. A nicer apartment. More delivery meals. More convenience. None of these decisions individually destroy your finances, but together, they quietly create a new monthly baseline. And the new baseline becomes difficult to reverse. Consider the math.